Welcome back to the portfolio, everyone. And today we're going over the top 3 REITs you should buy now, or definitely take a look at to see if they're a good fit for your portfolio. Right now, with all the closures, REIT industry is a little bit uncertain. Some people believe a lot of dividends are going to be cut moving forward, and a lot of REITs may go under because of their high debt levels. But I'm going to share with you 3 REITs today that I believe are going to continue to grow during this time of uncertainty, and I believe their dividends are very safe, and I believe the consistent income is going to continue to come in each month from these companies. As well, they're going to have some nice price appreciation moving forward, and these REITs are not your typical commercial or residential REITs. These REITs operate in a little bit of a different sector that I believe has high demand moving forward and will continue to grow. So before we jump into the top 3 picks, we're going to just take a quick look at my portfolio, currently sitting at a value at $35,336. We did have a little gain on the last market day, up over 1%, around $357. Total portfolio is still down around 14%, around a $5,300 loss in portfolio value. But of course, those dividends keep coming in, we keep reinvesting, we keep contributing more to the portfolio, and it will only grow moving forward over the long term. So we're going to jump right into the first pick, but I am going to ask you to please like and subscribe. It really does help my channel grow, and I do appreciate everyone who takes the quick second to do that. So the first REIT on our list is Digital Realty Trust, trading at $145 a share, and ticker symbol is DLR. So if you take a look here at this company, we'll go over exactly what this company does, but if you look at their 10-year price chart, their price has had nice appreciation. The price has around tripled in the past 10 years. They pay out a very nice 3% dividend with a market cap just over $40 billion. This is a very large REIT. It's not one of those small REITs that may only operate in one part of a country or sector. This is a massive REIT with a value around $40 billion. And of course, it is trading at a forward FOO of 5.89. So we're going to take a look at the company description. If you don't know what DLR does, they support data centers. So some of their main products and customers range from cloud and information technology services, communication, social networking, and financial services, manufacturing, energy, healthcare, and consumer products. So if you take a look at their customers who are in demand for their services, these are all the companies and all the services that remain open during these times of uncertainty. If you take a look, information technology, communication, social networking, financial services, all of these are customers who are still operating and still generating revenue during these times, and these are industries that are continuing to grow. So having these customers are high value customers because if the customers are growing, there's going to be more need for their call centers and their data centers. So that's what's going to help DLR continue to grow moving forward. So of course, this is a REIT, so it is in the real estate sector, and their subsector, their industry is specialized REITs. They have over 1,500 employees, like I said, with a $40 billion market cap. So of course, when you own REITs, a lot of people like that consistent dividend income that comes from REITs. So if you take a look here, their dividend yield is around 3%. Annual payout $4.48. 5-year dividend growth just over 5%. And they have a nice 15-year growth in their dividends. So I did skip over payout ratio. So if you don't understand this, with REITs, you don't want to take a look at their payout ratio. There's another metric called the FFO ratio, or the FFO payout ratio, which is what is similar to the payout ratio for regular stocks. Because REITs operate in a different manner, there's a different metric to take a look at. So I do not really involve payout ratio the same as I would for a normal stock. I take a look here at their income statement and all their financial information, and I scroll down right here and you take a look at FFO payout ratio, and this is very similar to the dividend payout ratio of a normal stock operating in a different sector. You want to make sure this number is safe. So once again, you can see here around 65% over the last 5 years, never reached over 70%. So what's very nice to see is that in 2015, their FFO payout ratio was around 68%. Then they got it down to 60, 64, 62, 63. So you have a very sustainable FFO payout ratio. They are keeping it low and they are making sure that it isn't growing over time. They're maintaining that certain level with the increased dividend payouts. So we take a look at their dividend safety score. They are very safe dividend, ranking in at 94. Like I said before, with a nice 3% yield. Their dividend growth is average. Last year was around 7%, but of course, over the past 5 years, it is averaging around a 5% dividend growth, with a beta around 87 and the price per share at $145 each. So of course, that is the first stock on this list. We're going to jump right into number 2. And if any of these stocks fit your investment portfolio, do some of your further research and check them out, and maybe they might be right for you. The second pick on this list is AMT, American Tower Corporation, of course another REIT, trading at $238 a share. And if you take a look here, we're going to start off with the 10-year price chart, and what you can see here is massive price appreciation over the long term. 10 years ago, price of the share was $38, now $238 a share, more than 6 times your money in the past 10 years. The price has grown. This is a massive company, once again, with a market cap of over $105 billion. Starting yield is a bit smaller at 1.8%. With this massive price appreciation, personally, I don't mind that little bit of starting yield. That is a bit lower. If we move over here to what they exactly do, American Tower, one of the largest global REITs and leading independent owner, operator, and developer of Mutulant communication real estate with a portfolio of approximately 171,000 communication sites. So once again, this is a specialized REIT. They do have over 5,000 employees, and they operate in such a large, vast area that this company has such a large moat that I do believe that it will continue to operate and continue to grow revenues moving forward. So if we take a look at their dividend summary, you can see here, of course, the starting low yield at 1.8%, annual payout $4.32 a share. We're going to skip over this dividend payout ratio right here and move over to their growth. But with the low yield, this is what I like to see. Massive dividend growth. 22% 5-year dividend growth average. That is remarkable. So if you buy into companies which have low starting yields but also have low dividend growth, that might not be the best for you if you are looking for that dividend income. If you buy companies with low starting yields, this is what I like to see. I like to see massive 5-year dividend growth rate of at least 10% to make up for that low starting yield. Dividend growth history around only 8 years, which isn't the longest, but of course isn't anything to be too worried about. Once again, we're going to take a look at their FFO payout ratio. So we are on the income statement right here. If we take a look at their FFO payout ratio, it is currently very low at around 45%, shy of 50% every year over the past 5 years. So you can see here is around 41, around 40, 40, 41, 46, 47. So it is below 50%. That is very nice to see. They do have a lot of money to continue to operate their business, as well as sustain that dividend moving forward, as well as increase it by that massive average of 22% in future years to continue to grow and to continue to provide investors with that nice dividend income. So once again, we're going to check out how safe their dividend is. If you take a look here, their dividend safety score is a 78, so that's considered safe. It is not very safe, but in no way does this score indicate that it is at risk of being cut or suspended. And as you see here, of course, dividend growth rate last year was 20%, which is extremely fast, with the massive market cap of over $100 billion. So that was number 2 pick on this list. That was American Tower Corporation, ticker symbol AMT. And we're going to jump into the third REIT you should take a look at right now, EQIX. So this is ticker symbol EQIX, trading at $678 a share. So of course, this share price is extremely high, but a lot of brokerages out there do offer fractional shares. So if you do have that feature, you may want to take a look at this and only put in as much as you want or as much as available to you. So on their 10-year price chart, stock was trading at $85 a share 10 years ago. Now, of course, up to $678 a share. So we see some massive price appreciation on this stock as well. Once again, a little bit lower of a starting yield at $1.57, with a market cap around $58 billion. So once again, this is another massive company. I'm not sharing with you any smaller speculative companies. These are bigger, badder companies that do have large moats and do have very large operations. So we're going to take a look at their overview. Once again, if you do not know what this company does, of course, they are another specialized REIT. So they connect the world's leading businesses to their customers, employees, and partners inside the most interconnected data centers on this global platform from digital business. Companies come together across more than 50 markets on 5 continents to reach out everywhere, interconnect everyone, and integrate everything they need to create digital futures. So of course, as you can see, they are extremely dedicated and they operate within the digital world, which is only growing year in and year out. So this is another REIT that I believe will continue to grow even during these times, because as you take a look at the overall market right now, the big tech companies, they are driving the growth of the market, and they are what keeping us out of these large dips right now. So the fact that this company tailors directly to them and this REIT operates directly in that industry, I really like that, and I really believe it will continue to grow moving forward, and is one that you should take a look at if you want to see some long-term price appreciation with a little bit of dividend income coming in as well. And if you take a look here, their dividend yield, of course, is very small at 1.57%. We're going to skip the payout ratio, and because they have not been growing their dividend for 5 years, there is no 5-year dividend growth rate here because their dividend growth history is only 4 years, which is the lowest on this list, but there's going to be some other reasons why I think you should still take a look at this one if you are interested. So we move over to their financials once again, and we're here at their FFO payout ratio, very sustainable FFO payout ratio once again. Every year over the last 5 years, it's been just around 60%. So 63, 69, 62, 59, 63, 65. So averaging between 60 and 65% FFO payout ratio, giving you a lot of income left over within the company to continue to increase and to continue to grow operations. And this is a perfect example of why I use FFO payout ratio to evaluate REITs and not like the standard payout ratio you use for a dividend paying stock of a normal company, is because if you take a look here, look at their dividend payout ratio using the old metrics. 210%, 400%, 265%, 202%, 164%, 170% payout ratio. So if you take a look at these numbers, you would stay away from this REIT entirely. You would think this is one of the worst REITs out there. You wouldn't really understand why their share price has been growing so much and how that dividend is even being paid out with these massive payout ratios. But if you take a look at the correct metric for REITs, or in my opinion, the correct metric, you can see here, their dividend is actually very sustainable. Their distribution is within a reasonable means, they're keeping enough income within the business to help grow operations moving forward, and this REIT may be one that you want to take a look at in the future for your portfolio. So if we take a look once again at their dividend safety score from Simply Safe Dividends, you can see here, their dividend is very safe. So that's what you have to understand. You have to do a little research with REITs because they do operate a little bit different, and your analysis has to be a bit different when evaluating and comparing them to a regular dividend stock. Because if you took a look at that dividend payout ratio, you would expect this score to be like in the red. You would expect Simply Safe Dividends to say that their dividend payout rate is very unsafe. Unsafe completely because they're paying out 100 to 300% of their income and their earnings per share. So when you have to take a look at the correct metrics, you understand that their dividend is very safe right now. Their payout ratio, their FFO payout ratio is very sustainable, and they will continue to pay it out moving forward. So of course, their dividend growth, they have not been growing it for 5 years, but last year they did grow it at 8%, which is nice to see. Another massive company at a market cap of $58 billion. So those are the 3 REITs I'm going to end off this video and share with you today. We're going to end it off by jumping back to the portfolio where I say thank you for tuning in. Those are my 3 REITs you should take a look at this week. And if you do like them, please check them out and do your own further research. Of course, I do not recommend any of these companies. I'm just sharing with you them for entertainment purposes only. And I appreciate you tuning in, and I'll catch you in the next one. Thanks.